I don't think that, I just want to clarify that I don't think that central bank buying of gold is really that important. And I don't mean that it's not going to drive the price. It will, but in the end, any central bank that has gold, it's not going to be enough. It's not going to save their currencies because they don't see gold as money. They see it as an asset through which they can manipulate the value of their currencies, which are the money. That's how they see it. In order for gold to be money for a central bank, they'd have to stockpile it and then stop printing and then let their banking systems all collapse, and none of them are willing to do that. So it's all a game for them, and it doesn't really matter how much they have. Eventually, in the end game, it'll all go into our hands, hopefully, and the central banks won't have any because they'll be busy selling it to try to save their currencies and then fail. That would be the best for us. It would be very traumatic for users of currencies, but that would be the best outcome.
Rafi Farber of Endgame Investors suggests that the data for the first quarter of 2025 could hint at emerging trends, particularly with central banks potentially increasing their gold purchases in response to rising geopolitical tensions and economic uncertainty. He notes that one key factor could be the threat of renewed tariffs under a possible Trump administration, which may prompt some governments to hedge risks through increased gold reserves. This shift comes when the global gold market is already experiencing a surge in physical demand. According to the World Gold Council's latest Gold Demand Trends report, gold had its strongest start to the year since 2016. Global metal consumption reached 1,206 tons in the first quarter, marking a 1% increase compared to last year. The report, released on Wednesday, highlights a broader shift in market sentiment as investors and institutions respond to the mounting economic risks. While strong physical demand has helped push gold prices to record highs over the past year, one major market component remained subdued until recently. Investor interest in gold-backed exchange-traded funds had been notably weak recently, but this has changed dramatically in 2025. While the actions of central banks can influence short-term price movements, Farber cautions against overestimating their strategic intentions. He emphasizes that although central banks continue accumulating gold, this does not reflect a belief in gold as money. Instead, gold is used to stabilize or adjust currency values, not as a replacement for fiat currency. In his view, central banks do not intend to abandon existing monetary systems or return to a gold standard. This perspective tempers expectations around institutional gold demand and serves as a reminder that the long-term drivers of the market remain complex and multifaceted. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
I looked at their list of countries, the top 15, 20 bullion holding by central bank, and China was in there. And the only ones that I saw that are buying gold right now, of course, I don't know. The data is only good through Q4 of 2024, so it doesn't account for the rally from February to now. So anything could happen. Nobody has that information yet, and when we have it, it'll be incomplete. But what I've seen is that the two central banks that are buying the most are actually Poland and India. So India has been buying consistently, and Poland as well. Turkey has also, they've been up and down. I think they're at a new high in their gold holdings, but they buy and they sell every month depending on what their currency does or how desperate they are, so I don't really rely on them. But China isn't buying much or hasn't bought much through Q4 2024. Russia hasn't bought any significant since 2020, or at least not that they're telling us. And Japan bought a bunch in 2021 but hasn't done anything lately. So there isn't that much going on, at least up to Q4 2024, except for Poland and India. And I think India has been more aggressive. Now, I don't know enough about the gold market dynamics to tell you if the buying between Poland and India is enough to push the price higher. I would suspect not, because they're also sellers. For example, Kazakhstan, which also showed up in the list, they were strong buyers up from, I think, like 2018 to 2022. Then they maxed out and they've been selling ever since. Not like huge amounts, but enough to cancel out some of the demand from Poland and India. So we're going to have to see what the numbers are for Q1 2025. And it could show some significant buyers there, some central banks getting nervous on the Trump tariffs. Who knows? I don't think that, I just want to clarify that I don't think that central bank buying of gold is really that important. And I don't mean that it's not going to drive the price. It will, but in the end, any central bank that has gold, it's not going to be enough. It's not going to save their currencies because they don't see gold as money. They see it as an asset through which they can manipulate the value of their currencies, which are the money. That's how they see it. In order for gold to be money for a central bank, they'd have to stockpile it and then stop printing and then let their banking systems all collapse, and none of them are willing to do that. So it's all a game for them, and it doesn't really matter how much they have. Eventually, in the end game, it'll all go into our hands, hopefully, and the central banks won't have any because they'll be busy selling it to try to save their currencies and then fail. That would be the best for us. It would be very traumatic for users of currencies, but that would be the best outcome.
Gold markets experienced a modest pullback during Wednesday's session, but the dip was met with buying interest, signaling that bullish sentiment remains intact. After a strong rally, gold had become somewhat overextended, so that the recent sideways movement could serve as a healthy consolidation phase. Despite the pause, many traders view gold as a favorable asset, driven by ongoing geopolitical tensions, a weakening U.S. dollar, and growing concerns over a potential recession in the United States. The uncertainty surrounding the broader macroeconomic landscape has reinforced gold's appeal as a safe haven asset. While it is unclear whether the metal will continue to consolidate or begin another breakout, current sentiment suggests that market participants are still eager to buy on dips. The $3,500 level stands out as a significant resistance zone, but with sustained interest and time, it is likely to be challenged. Adding to this outlook, Rafi Farber notes that even if gold undergoes another sell-off, the decline is expected to be shallow in price or brief. He believes any sudden drop may be little more than a temporary correction before the next leg of the rally resumes. This view aligns with the broader trend of gold being resilient in the face of short-term volatility, as underlying demand, both physical and investment-driven, continues to support higher prices. Let's get back to the interview.
Open interest is one of the main metrics that I follow. It shows how many people have bets open either on the long side or short side. They always equal each other out because every long there's a short. How many of those contracts are open? So how much notional value of gold is being traded at any one time? And the lowest that we've gotten post 2008, 2008 itself, the dip of that crisis, I think it went down into 300,000s and maybe in the high 200,000s, if I remember correctly. I don't remember exactly. But the lowest that we've gotten since then has been about 400,000. And we're just above that now at about 450. 460 something like that, and that's a very low number. And before this rally, you could say it started in January, February. If you look at the interplay between price and open interest, usually they go up together and down together, and then open interest resets, and then you start another rally. It's like, a ratchet. So the price keeps going up, but as it goes up, open interest goes up, and then open interest goes down again, and the gold price goes down a little bit, but then ratchets up again to go higher. It's that sort of movement. And so when we see something like open interest falling, 100,000 contracts, 150,000 contracts. I don't know exactly how much it's fallen since January. It's something around there. But the price is going higher anyway. That means that the shorts are closing their contracts. They're buying back their short positions either with dollars or with deliveries. Right? They can close their contracts by delivering gold, and their dollar positions don't really change. So that's what the bullion banks do. So that's how they hedge, right? So if they're short a contract, doesn't mean they're shorting gold outright. It means they're shorting the futures, and then they bought the physical somewhere. And I think that's where the deliveries come in, right? It's the bullion banks that are delivering gold into their short positions so that it doesn't really affect their accounting. They can do that as long as there's enough gold to do it. And so far there is. So I think the fact that open interest is so low, and a lot of it is down because of these deliveries, every time a contract is delivered, that open interest is erased, right? And that means that the amount of speculation in gold futures now, not for delivery, but just to speculate on the price, is very low. Otherwise, open interest would be higher. And because it's so low, that means that there's room for it to move higher because the speculators that drive price on the margins are not in the market right now. They're gone. I think they were in a little bit when we hit 3,500, but even then, open interest was still pretty low. I mean, we can get as high as 600, 650,000 before it really gets into the nosebleed section. The highest we ever gotten was right before the 2020 COVID crisis. I think around January, February 2020, it was like 850,000. That's abnormal, but a high number would be around 600,000. We're nowhere near that. There's plenty of room to run in the rally. And what I do is I show the bars of open interest in accordance with the price on the top, and I draw a rectangle so you can see that every time there's a local low in open interest that usually correlates with a local low in the price. Not every time, but it's pretty reliable. So then I would say for that reason that if there's going to be a further sell-off in gold, it will either be shallow in price, meaning it won't go much lower than it is now, or, you could have a very brief blip I don't know, I'm just saying a number just to pick a number, 3,000 or whatever, which used to be, a big high watermark a few weeks ago. And now it's like, oh my God, 3,000, gold's crashing. So, everything's changing so fast now in our retail. We can't keep up with the reality. Yeah. So that could happen, but if it does happen, that would be the bottom, and then we'd be on our way up. So either short in any continued correction for would be short in time, or shallow in price. That's what I would speculate.
Though central banks are visible in current momentum, their actions reflect tactical maneuvers rather than ideological commitment to monetary reform. With persistent demand across both institutional and retail fronts, the metal's resilience seems poised to define the next phase of value preservation strategies. Could this growing reliance on tangible reserves signal a broader rethink of how nations and investors anchor financial stability in uncertain times? Share your perspective in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.